So in the last video, we talked about the notion of comprehensive income and how it's kind of a little bit hard to understand because we already have net income, and so why do we need a more comprehensive version? And then we basically came up with, well, obviously net income does not include everything. There are some things that are excluded and they don't go through net income. They bypass the income statement altogether, and yet they still affect equity, thus meaning that we need a more comprehensive version of income, which we call comprehensive income. So when we have comprehensive income, we basically have this account that we'll call here OCI, just short for other comprehensive income, and that's just these changes that bypass the income statement for that quarter, for that year, whatever those effects are. We're just going to call them other comprehensive income. And we talked already about how to present comprehensive income in the in the financial statements, but we really haven't talked about what is in other comprehensive income. What are the transactions that are driving this? What are the things that are bypassing the income statement? So in this video, we're going to kind of talk about those things and why they might be there. So we've got unrealized gains and losses on available for sale securities. That's a very common thing that you might see. So a firm buys some securities. They're not trading securities. They're not held to maturity securities. They're available for sale. Now, if there's some kind of fair value change, which there most likely will be in those securities, right? The fair value goes up or it goes down. Then at the end of the quarter, the end of the year, you're going to have an unrealized gain or loss, right? So if you bought the securities for $100 and then they go up to 105, they're worth 105 at the end of the quarter, well, you've had an unrealized gain there of 5. And it's unrealized because you haven't sold the securities yet. You still have them, but you've had this gain, right? There's been a real change in the value. So you might think, well, why doesn't this go to the income statement? That sounds like income, right? The firm's fair value of some measurable assets is increased. Well, the reason that we've kind of got these OCI items to begin with is that firms say, they kind of lobbied and said these things don't really, they really shouldn't be going through income because they introduce a lot of volatility. Right, there's a lot of volatility here that we really can't manage. It doesn't really have to do with our core business operations. And so, though it affects equity, we should kind of ignore these things, or they should be off to the side. And so what firms, they buy these securities and they have the fair value changes frequently. And the firms don't want that volatility being introduced to the income statement because, as we talked about before, they want smooth income over time, right? They don't want any kind of volatility. They don't want up and down jumps in net income. So if they can kind of get these things that are changing out of the income statement, then they don't have to worry about that volatility. And so unrealized gains and losses on available for sale securities are one thing, but we also have when there's a gain or loss on the effective portion of a cash flow hedge. So a cash flow hedge is a type of derivative, which I won't get into here, but I think it's just good that you know the different things that can affect OCI. And also we have, if there's any kind of gain or loss, when the firm is translating its financial statements from a foreign currency into the currency that it's presenting the financial statements in. So when there's any kind of translation like that, any kind of foreign currency translation, there ends up being a gain or loss, that also is going to be part of OCI, as well as any gain or loss, any actuarial gain or loss from a defined benefit pension plan. So when we look at, these are the four things. Now, of course, that can change. The FASB can certainly decide that in the future certain other things might be included in OCI. But as of right now, if you see other comprehensive income for a given period for a firm, these are the items that supposedly introduce volatility, and they're going to bypass the income statement. They're going to go to this other comprehensive income account and ultimately become a part of comprehensive income.